what is the best investment, meaning one that there would be less worry of any kind connected with, and less people coming around and saying, why don't you sell this and do something else and all those things. She's going to have more money than she needs.
This is Warren Buffett talking about his wife's investment plan for when he's no longer around. The surprising thing that he didn't reveal here is that there are 3 types of investments that'll allow you to live like Warren Buffett and never have to worry about it again. It's true that some investments take your money, like a car, and some put more money in your pocket, like stocks. When you invest, you look to be more financially free so you can do the things you want to do and never worry about money. When I researched Warren Buffett, I was shocked by what I found. The truth is that all investments don't work the same, and you need these 3 to truly become financially free, and it all starts with this. Number 1, real estate.
If you look at real estate generally, you'll understand what the phenomena that's happening if you remind yourself that that's the attitude of most people that have become big in the real estate business.
So what is the attitude of most successful people regarding real estate, as Warren Buffett said here? Well, when people invest in real estate, they're looking to make passive income. One popular method for generating passive income cash flow is through dividends, which is when you purchase shares of a company, like Coca-Cola, and then they pay you cash from their profits every 3 months. However, real estate is a much better option in terms of cash flow, and I'll show you why.
Yeah, Charlie and I mean both, more Charlie than I, we've had certain personal real estate investments over time, and it's a field that in general we understand. We don't bring that much special to the game, but we understand it. We've made money in it.
The way real estate works is that you buy some kind of property, like a house or an apartment complex, and rent it out to someone for a specific price which they pay directly to you. For example, let's say you buy a family home and rent it out to a couple. You rent it out to them for whatever the price is reasonable and give you a profit every single month. Once you own that property, you no longer have to do any work since it's an asset you own and cash comes to you. The real reason that real estate is best for cash flow is because if it's done right, you'll have all the expenses covered and make a profit. To take it one step further, you can even get a property management company to take care of the tedious details like fixing plumbing or electricity, meaning all you need to do is think about getting that next payout in the mail. So the great thing is that real estate is relatively passive and you make money, but there's more to it. As Warren Buffett said, never invest in a business you can't understand. So keep watching to make you fully understand real estate. In fact, one of the biggest benefits of real estate is the tax breaks you get.
Well, Berkshire's never been very active in commercial real estate. It works better for taxable investors than it does for corporations taxed the way Berkshire is.
Many of you may not realize this, but one of the reasons the rich are so rich is because they find assets that cut their taxes down. It's one of the reasons why Warren Buffett is so rich, for example. When it comes to real estate, however, it greatly benefits the individual investor, like you. In the IRS rulebook, there's a major tax break that allows you to list out your home for a tax deduction. I'll illustrate with an example. Let's say that you rent out a home for $1,600 a month. The current expenses for the property add up to $1,000 a month for things like mortgage, maintenance, insurance, property taxes, etc. That means you'd make a total profit of $600 per month. That means every year you'd make $7,200. Here's the problem. The $7,200 profit is considered income, and that means it needs to be taxed. But here's a pleasant surprise. It turns out that you can take a huge tax break because the money is made through real estate. Let's say you put $19,000 for the land and $155,000 for the house. Now, after it's been rented for a year, you tell the IRS that it's 1 year older, meaning it's depreciated. So you tell the IRS that you deserve a tax break of $6,600. But how does this work? How can you only pay taxes on $600 even if you made $7,200? Turns out there's something known as depreciation expense, allowing you to file your taxes and pay minimally on your income. But this isn't the only reason why rich people love real estate. Turns out there's another way to loophole through taxes legally, except this one is even more impressive.
All my rich friends who own real estate are selling their worst properties, and they're getting bids that come in higher than their highest expectations, and people are competing to take these things off their hands.
I'll show you just how impactful Munger's words are here just in a moment. But let's go back to our home example. You paid a total of $174,000 for both the land and the home. Let's say you've owned the property for a while and you've rented out for just as many years. You've been slowly incrementing the rent year by year. Out of curiosity, you go on Zillow and you see the prices of your homes in your area and you see a whopping sale price of $1.5 million. This is an exaggerated example of speedy growth, but I promise you it'll give you a good idea of what you can expect. Since you see this massive number, you decide to sell it to get a huge amount of money. But the same problem with taxes arises. This money is considered income, and you'll be massively taxed on it. Or so you think. The way around this is that you can use the money to buy a bigger unit with several places to rent. For instance, a triplex or even multiple homes to rent out multiple families to increase your cash flow. If you decide to buy a home with that $1.3 million profit, you won't have to pay a single cent in taxes. Yes, not even a cent. This is known as the 1031 exchange, or the like-kind exchange, which is a specific real estate law. Essentially, if you use any money you've earned from selling a real estate property to buy another property, then you don't have to pay any taxes. Before you get too excited, make sure to talk to a professional about this, as there are a lot of legal things to consider before getting into real estate. Since opportunities to sell your home for such an increase are rare, remember this: opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Warren Buffett. So you think you understand real estate and you're ready to get started, right? Well, there's a little more you need to know. Firstly, there are several types of real estate: commercial, residential, and REITs. Turns out that Warren Buffett at one time had a massive REIT portfolio.
Actually, at the time that the NASDAQ about hit its high, REITs were quite cheap in my view, and I have less than 1% of my net worth outside of Berkshire, but basically I had that portion all in REITs. They were all small ones at that time, but they were selling at discounts. At that time, they were selling at discounts to the values of properties, and those values of properties were much more conservatively figured than today.
However, when it comes to cash flow, residential is one of the best choices you can make. When you think about it, everyone needs a home over their heads regardless of the economic conditions present. It's hard to say the same for commercial real estate, as businesses tend to dial back during economic hardship. So, if you want to get into physical real estate, then going for family homes or apartment complexes will serve you well. But how do you decide what property to take? If you think looking for high growth areas, low crime rates, or potential growth is it, then you're wrong. Since this is primarily for cash flow, you want to look at for how much cash you can get out of your property starting today. A rule of thumb is that you should aim for 7% returns. That means for every dollar you invest, you should get 7 cents back. So, if you invested $200,000, then you should see $14,000 in cash flow. Your goal isn't growth, but cash flow. Growth is just the cherry on top for real estate. But there's a way to use growth entirely, and that's the second asset you need to invest in. Number 2, businesses. The goal of investing in businesses is to provide growth. The reason is that the more value means the more money made.
Hard-earned money.
The thing about real estate is that the growth isn't optimized. You can get a solid cash flow, but growth is largely dependent on location, and it can be really variable depending on the current situation. Whereas businesses primarily focus on growth. The more money you put into a business, the more money it has to put into a high-growth operation, like hiring more employees, innovating new products, and selling more aggressively. There are 3 ways to invest in businesses, and they depend on your risk tolerance. The first and least risky way is the stock market. The stock market holds highly established businesses that have been around for a while and are unlikely to go bankrupt anytime soon. The 2 main ways to invest in the stock market are through individual companies and ETFs. The first takes a lot of time and study since you have to research the companies. This has the potential to give great growth on your capital. The other, easier way is to invest in ETFs, which gives you a broad exposure to markets or sectors. It takes a lot less effort, but you still get solid growth. The second way is through your own business.
If you're the best doctor in town, if you're the best lawyer in town, if you're the best whatever it may be, no matter whether people are paying you with $1 zillion or paying you, they're going to give you some of what they produce in exchange for what you deliver.
Just as Buffett said, investing in yourself will not only make people flock to you because of the high-quality services you offer, but are willing to give you a lot of money for it. The truth is that investing in yourself and a business idea can have massive returns. The problem is that not everyone is suited to be an entrepreneur. It's a lot more work than it seems, and you need a lot of discipline. The reason why it's a risky venture is that some people may think that they're cut out for it only to realize they're not, and they end up losing more than they gain. The last way is through startups. You are essentially investing in other people who are trying to be a business. Here, you have the potential to find the next Amazon or Microsoft before they ever had their name. There's huge potential for success, but just as high potential for failure. Some websites you can check out are WeFunder, Start Engine, and Republic. When investing for growth, there's something important to consider: that you're trying to grow your capital through equity. Let me explain. When you earn money through work, it's fixed. When you make $60,000 a year, that's all you make. However, when a company makes $60,000 a year in profit, it may make them worth $600,000 or 10 times a multiple of it. The stock market prices are based on the perceived worth of the company, meaning the more a company earns, the greater its value will be, and the more you'll make. We live in a capitalist world, and this is why true wealth is built this way. You make money through capital, not labor. That's why when you invest your capital through the money you make with your labor, you can get rich. But what happens when things drastically change? Is there a way to protect yourself? Well, let me introduce you to Asset 3.
Hard-earned money.
Number 3, real money protection. You never know what'll happen in the future, so being protected is critical. For example, if America collapses, the dollar tanks, and businesses aren't worth much, you want to still have value in your money. The best way to use a traditional hedge against inflation is gold. Gold is a universal currency that in any country you go to, everyone knows the value, and it stays the same. In the modern world, Bitcoin is slowly becoming the digital version of gold. As of right now, it doesn't have the same potency and stability as gold, but it's getting there. However, when it comes to these assets, you want to think of them all differently. You don't want to worry about the current price, but just to have it in case the currency you live with really starts becoming worthless. That way, if you need to get out and have your money exchanged to a different currency, you can still get high value. It'll ensure that you're always safe regardless of what happens and where you are.